Hi there. This is Matt with Venture Science. I want to talk to you about something I'm personally very excited about. When I wrote about quantitative investment methods in venture capital over a decade ago on TechCrunch, I had no idea that this approach would gain so much attention in the investment world. In fact, many VC firms in Silicon Valley, in and around the world today, have quant analysts working for them. And the gut feeling based investment models are now a thing of the past. My article has been translated to many languages, and I thank everyone for their immense support and interest. So fast forward to today, we believe that the old VC model is due for another fundamental upgrade. But before I go into that, let's take a step back and look at the evolution of venture capital. So for decades, the venture capital model has been built around 10-year closed-end funds. These funds deploy capital in the early years, wait for companies to mature, and eventually, or hopefully, return capital to their investors through exits, like IPOs or acquisitions. Now, that model works well for a while, but has serious limitations. One, sometimes it forces funds to exit too early, even when long-term upside remains. Why? Because fund managers typically want to raise new funds, and returning capital to investors paves the way for that. Two, it locks investors into rigid cycles, limiting flexibility and adapting to market conditions. Three, it separates private and public market investing, ignoring opportunities in the crossover space. So today, we believe in removing these constraints. The distinction between private and public markets is becoming increasingly blurred. Now think about it. Companies are staying private longer than ever. While startups used to go public in 4 to 6 years, today's tech giants, companies like SpaceX, Stripe, OpenAI, are choosing to remain private for a decade or more. At the same time, public markets have access to growth opportunities that resemble venture capital investments, especially in sectors like AI, deep tech, quantum computing, biotechnology. Years ago, when venture capital first took off, there weren't that many innovative companies on the public side. So people were looking for these needles and haystacks in startups. But that was a long time ago. Today, we have very innovative companies on the public side. Just look at any one of the mega cap tech companies and even some of the smaller ones. You'll see not only they're well established, but also employ thousands of super smart engineers who are working on innovative products every day with the massive resources that these companies offer. Now, don't get me wrong, startups aren't going anywhere. Startups are the fiber, the heart, and the soul of innovation. Always has been and always will be. We feel very fortunate to live and work here in Silicon Valley and come across amazing founders every day. And we want to back these founders, no doubt about that. But why, as investors, should we be forced to choose between one or the other? So we think today a hybrid investment fund makes more sense. A hybrid model allows us to back promising startups early while also investing in public companies leading disruption. We capture upside from pre-IPO companies, avoiding the rush to exit too soon. We deploy capital dynamically, adjusting exposure between private and public assets based on market conditions. The reality is, technology-driven investing is no longer should be confined to one asset class, and our investment approach should be either. Traditional venture funds require LPs to commit capital for a decade or more before seeing meaningful returns. Now, that structure made sense in an era where exits were predictable, but in today's dynamic environment, investors need liquidity and adaptability. A hybrid model offers longer compounding periods, so we can hold companies beyond artificial exit timelines. We have more liquidity possibilities. The investors can get exposure to high growth opportunities without being locked into a decade-long commitment. We have better risk management, and the ability to shift capital between private and public assets reduces volatility. So this model isn't just an evolution, it's a necessary upgrade for the next era of venture capital. And at my firm, Venture Science, we are doubling down on AI, quantum computing, deep tech, sectors that require patient capital and a flexible investment approach. And by leveraging quantitative analysis, decision science, and multi-asset investing, we are creating a fund that's built for the future, not just for the old venture playbook. So if you're an investor looking to access the most transformative companies, private or public, before they reach mainstream attention or after they're established. We believe that this is the model that will define the next decade of venture capital, and we're just getting started. So if this resonates with you, please like and subscribe to this podcast for more insights into the future of investing. Let's build the next generation of venture capital together.